All right, in this lesson we're going to talk about Chapter 11, the capital asset pricing model. We're going to skip a lot of the derivation of the model and sort of talk about the motivation for it, the underlying intuition. Key concepts: how do you calculate expected return and covariances, correlations, and betas. Understanding the impact of diversification, understanding the systematic risk principle. We're going to talk about the security market line and the risk-return trade-off. And then finally we'll just kind of wave our hands and up will come the capital asset pricing model. Chapter is outlined as shown here. Those of you who have a textbook will find this slide completely useless. So let's talk about individual securities. We talked about this last lesson. The characteristics of individual securities that are of interest are expected return, variance, and standard deviation. And when we start talking about portfolios, meaning a collection of more than one security, we're going to be interested in covariance and correlation. So let's take a look at a couple of funds. Now here we have a bond fund and a stock fund, and we have three scenarios, three states of the economy. The first is a recession, the second is a normal economy, the third is a boom. And as you can see, we've decided that they're about equally likely. There's about a 1/3 probability of recession, a 1/3 probability of boom, a 1/3 probability of normal. In the event that we have a recession, stocks will do poorly, will lose 7%, and bonds will do quite well. That's because, as you recall, when rates go down, bond prices go up, and rates usually go down during a recession. During a normal period, we expect stocks to earn about 12% and the bond fund to earn 7%, and in a boom we expect stocks to really do well, earning 28%, but bonds will probably do poorly, losing about 3%. So if we calculate the expected return and the standard deviation and variance for each of these two funds, first the stock fund, first thing you notice is that the expected return is equal to a weighted average of the returns in the three states. So 1/3 of the recession return, 1/3 plus 1/3 of the normal return plus 1/3 of the boom return gives us an expected return of 11%. Now if we take that 11% and subtract it from the -7, -7 minus 11 is -18, that will be a deviation. And if we square 18%, we get 0.0324, like that. So we do that again with a normal. 11% or 12% minus 11% is 1%. 1% squared is 0.0001. And 28 minus 11 would give us a positive 17, and 17 squared is 0.0289. So those are the squared deviations. And if we then add those up and divide by 3, or if we take 1/3 of each one, in other words the weighted average of the squared deviations, we get 0.0205, and that is the variance of the stock fund. We would do the same thing. I'm not going to go through it again with the bond fund. But if we take the square root of the variance, we get the standard deviation. So this tells us that, going back to Chapter 11, Chapter 10, if we assume that returns are sort of normal, normally distributed, then there would be about a 68% chance that we would have 11% plus or minus 14.3, plus or minus 1 standard deviation. Now, if we talk about covariance, we do the following. We take the stock deviation, we don't square it, so we subtract the mean of the stock fund from each of the states, and we get the bond deviation, and then we take the product of those two. So minus 0.18 times 0.1 gives us minus 0.018. We take that product and then we weight by the probability of recession, which is 1/3, which gives us the weighted product. And then we add those up, and the sum is called the covariance. So the covariance is negative in this case, and what that tells us is that the bond fund and the stock fund tend to move in opposite directions. It doesn't tell us how strong the relation is, but it tells us there's a negative relation between stocks and bond returns. Now, if we want to determine how strong the negative relation is, we calculate the correlation. The nice thing about correlations is that they are standardized and they must be between +1 and -1. A +1 means that two variables are they move perfectly in sync. When one goes up, the other goes up. When one goes down, the other goes down. They always move together. A -1 means they move exactly in opposite directions. And you can see that the correlation for the stock fund and the bond fund is -0.998, almost a perfect -1. So this stock fund and this bond fund have returns that move almost inversely with each other, almost perfectly inversely. Notice the equation there. The correlation coefficient is equal to the covariance divided by the standard deviation of A and the standard deviation of B. So let's now look at a portfolio. So here we have, just to remind you again, we have the stock fund, we have the expected return, we have the variance, we have the standard deviation, and we have the bond fund, we have the expected return, the variance, and the standard deviation. Let's see what happens if we form a new portfolio that consists of 1/2 the stock fund and 1/2 the bond fund. So let's say we have $100. We're going to put $50 into the stock fund and $50 into the bond fund. So half in one, half in the other. If we do that, let's just talk about a couple of these lines. Notice first that if we have a recession, the stock fund will lose 7%. The bond fund will make 17%. -7 plus 17 is +10, and 2 into 10 is 5. So the average return, if we have half stocks and half bonds, our average return in a recession would be +5%. Our average return in a normal economy would be 9.5, and our average return in a boom would be 12.5. Now, if we calculate the expected return, and down here you see how the returns are calculated. The return on the portfolio is equal to 1/2 the return on the bonds plus 1/2 the return on the stocks. And that's how we got that first 5%. Now, if we calculate the expected return, we would do it just as we did for the stock fund earlier. The expected return is the weighted average of the portfolio returns, and it works out to 9% even. And the standard deviation now, notice it has dropped dramatically, and it is now 3.08. What is the source of that dramatic decrease? Because if you notice, the expected return of the portfolio is exactly halfway between the bond fund and the stock fund, just exactly halfway. But the expected standard deviation of the portfolio is lower than either the bond fund or the stock fund. So we've had a dramatic decrease in risk or standard deviation, and the question would be, why does that happen? And the reason is, the reason is that we have what's called diversification, and I'm going to get to that in just a minute. But here's the calculation of the expected return. Half of the expected return on the bond fund and half the expected return on the stock fund is the expected return on the portfolio. But when we talk about the variance of the portfolio, we get this sort of complicated expression that says the variance of a portfolio is equal to, in this case it would be 50%, the weight we put in bonds times the standard deviation of bonds, then we square that. Then we take the weight on stocks times the standard deviation of stocks and square that. Then we add this term twice, the weight on bonds times the standard deviation of bonds times the weight on stocks times the standard deviation on stocks times the correlation coefficient between bonds and stocks. Now remember, that correlation coefficient was almost -1. It was almost perfectly negative, and that means this third term is actually a negative. So the first term is positive, the second term is positive, but we're actually subtracting a pretty good sized term from the sum, And that's why we get this big drop in the standard deviation, because of that negative covariance. So observe that the decrease in risk that the diversification offers, an equally weighted portfolio of half stocks and half bonds has less risk than either the stock or the bonds held in isolation. Now, if we were to create a whole bunch of different portfolios and do the same calculation for each portfolio, let's take a look here. Here is a portfolio that has, well, let's look at the red one. The red one is the one we just went through. It has 50% in stocks, and so by default, it has 50% in bonds. And so the risk was 3.08, that was the standard deviation, and the expected return was 9. And that turns out to be this red dot right here, this big red dot on this graph. Now, if we were to choose no stocks and 100% bonds, we would get the expected return on the bond portfolio and the expected risk of the bond portfolio. And if we were to do the same thing with 100% in stocks and no bonds, this would be the expected return of the stock portfolio and the standard deviation of the stock portfolio. Now over here we've put a point on this graph for each one of these portfolios, and I haven't counted them, but I think there are around 20 of them. And you notice that it has this sort of bullet shape. It starts out over here with 100% stocks. As we begin to add bonds, we get some diversification. When we're half bonds, half stocks, we're at this red dot here. We continue to go down until we reach a minimum level of risk, and then we start going back the other way. So as we begin to add beyond this point, as we add more bonds, we begin to increase risk. We continue to decrease portfolio return, but we begin to increase risk. All right. Now, the part of this graph that's circled is called the efficient set. And the reason it's the efficient set is because any point up here on this line is preferred to any point down here. So for example, if you take just a specific level of risk, now in general, we don't like risk and we do like return. So if you take any particular level of risk, here's about 6% at this point, we can always go up here on the top part of this graph, throw in more stocks, and actually have the same amount of risk but get a higher rate of return. So we would always prefer to move up and to the left on this graph, and therefore the part that's circled is the dominant set or the efficient set. Now, you could ask yourself, well, all right, that was an example where the correlation was almost a perfect negative number. What would happen if the correlation were almost perfectly positive, or in fact, if it were perfectly positive? What would happen if every time the stock went up, the bond went up? Well, it turns out in that case we really don't get any diversification in the risk, and the risk at any point is exactly proportional. It's on a straight line. The risk and return are on a straight line between the stock fund and the bond fund. So we really, if we had half stock and half bond, we'd get half the expected return and half the risk. So if stocks, if whatever assets we have are perfectly positively correlated, we really don't get much benefit from diversification. Now on the other hand, here's a portfolio with a correlation coefficient of 0.2. It's nearly zero, which means these two things, they move together in a positive way, but it's a weak positive. And what you see is this red line, so we do get some diversification, we get some reduction in risk as we move from stocks to bonds, and then at some point we kind of bottom out, and then as we add more bonds we begin to move back up in the risk category. And then finally the one that we just looked at, a little bit more extreme, a perfect negative correlation, is actually the juxtaposition or collection of two straight lines. And it is actually possible, if you have a perfect negative correlation, to find a portfolio that has no standard deviation whatsoever. In other words, the sigma, the standard deviation is 0, and the return is, there's still positive return. So that is positive. All right. Now, let's suppose that we take a number of securities, not just two, not just a bond fund and a stock fund, but a whole bunch of things, and put them together, and we find the collection of portfolios that are possible. That would be, we would call that an opportunity set, and it would be this, this set of points not only along this red line but also inside of it. All of these points in here are possibilities. And this red line is what we would call the efficient frontier. It's the outer edge of all the possible portfolios that we could form. And as you might guess, the positive part of this, from about here on up, would be called the efficient set. So the efficient set, this little light colored area, or the efficient frontier, sometimes called, is the set of portfolios that we can form that dominate, in the sense that either for a given level of risk we get a higher return, or for a given return we get less risk. Now there is a portfolio on this efficient set called the minimum variance portfolio, and it is possible mathematically to find that, although that's not primarily of interest to us. Now next, what we want to do is add a risk-free asset to the mix. This could be something like a treasury bill, some kind of government security that has very low default risk. And we ask ourselves, what would we do if we could form a portfolio? Now, since this is a risk-free asset, we're going to assume that it has no standard deviation. So it's down here with the standard deviation of 0, and it has a certain return. What would happen if we were to form a portfolio of the risk-free asset and some portfolio up here on the efficient frontier? Well, it will turn out that what we'll want to do is we'll want to use specifically the portfolio that lets us get as far out on the edge of this efficient frontier as possible. And when we take that, we'll call it a balanced fund, or sometimes they call it the market portfolio. When we take that balanced fund and combine it with the risk-free rate, we can actually put ourselves anywhere on this thing labeled CML. And CML stands for Capital Market Line. And so actually, if we invest some of our money in the risk-free asset and some in the balanced fund, will be along this line here. And then if we assume that we can borrow at the risk-free rate and buy more than 100% of the balanced portfolio, we can extend our returns and go anywhere up here on this part of the straight line. All right, so with the risk-free asset available and an efficient frontier identified, we will choose the market line that is just tangent, just touches this efficient frontier, and we're going to call that line the capital market line, and we're going to say that any investor can put themselves on that line by forming a portfolio consisting of some of the risk-free asset and some of this market portfolio. Now obviously, if you have 100% of the risk-free asset, you'll be down here, and if you have 100% of the market portfolio, you'll be here, and if you borrow money and buy more than 100% of the market portfolio, you'll be up here. The other thing I want to point out is this capital market line is more efficient than what we used to call the efficient frontier. Because let's say I'm right here where this little arrow is. With the same level of risk, I can go straight up and get more return by investing in the capital market line. Or let's say that I'm right here, for example. Let's say in fact that I have the minimum variance portfolio. I can actually get less variance with the same return by moving over and putting some of my assets into the risk-free rate and some into the market portfolio. So the capital market line actually dominates the efficient frontier. Now let's change directions a little bit and talk about information. Realized returns, what you actually get, is usually not what you expect in beforehand. So I might hold a stock, I might hold some IBM, I think maybe I'm going to earn 20% next year. I'll earn something, but it's probably not going to be 20%. It could be more, it could be less. And so I could argue, well, there was an expected component, that was the 20%, and then there was a surprise. And the surprise would be positive if I earned more than 20% and negative if I earned less than 20%. So at any point this unexpected return could be either positive or negative. Over time, however, I would assume that the unexpected part averages out to zero. In other words, sometimes things work better than I expected, sometimes they work worse, but on average the errors work out to zero. If they're always positive, then I would probably raise my estimate. If they're always negative, I would probably lower my estimate. So when my estimate is about right, I should on average, the unexpected component should average out to zero. Now, what moves stocks? Well, it turns out that the thing that moves stocks is news. And when we get news, it's, why is it called news? Because it's unexpected. And it contains both perhaps an expected component and a surprise component. So a company announces its earnings. Well, we're not surprised that it announced its earnings, and we have a part of that we expected. We expected some earnings, but maybe the earnings are higher or lower than we thought, and so there's an unexpected component as well. It's the surprise component that really affects a stock's price, and therefore its return. So if you get news and it's expected and it's what you thought it would be, it's probably already priced into the stock, and it's not going to move the stock price very much. But if you get some news and it's a surprise and investors are sort of caught flat-footed, then the stock is likely to react. Now it turns out that people who study this discover that stocks react very quickly, and they react in the correct way. So they're rational. But it's the surprise component that causes stocks to move. And here's the point, very obvious when we watch how stock prices move when an unexpected earnings announcement comes. So let's talk about risk now, systematic risk. Systematic risk is what it sounds like. It's risk that affects the entire system. In other words, it affects the whole body of stocks, the entire universe of stocks. It is also known as non-diversifiable risk or market risk. Well, why is it non-diversifiable? Let's say we have some bad news. Let's say we discover that, I don't know, a president was assassinated, or there has been a terrorist attack, or oil prices tripled, or something of that sort. In that case, that's going to cause a ripple effect throughout the economy, and all stocks are going to be affected. So it's not diversifiable. Holding a portfolio won't let you escape that kind of risk. Changes in the gross domestic product listed here, inflation and interest rates, those are other examples. Now we have, besides systematic risk, we have unsystematic risk, and as it's sometimes called idiosyncratic or firm-specific, it is risk that affects a limited number of assets, but not the entire economy, just maybe even one stock it could be. It's also known as unique risk and asset-specific risk. And it includes things like labor strikes, part shortages, even, just you can think of a million things. Patent infringement suits, the CEO retires, the company is sued, all kinds of things. So now a return consists of two things. It consists of the return from the expected component, the expected news, and the unexpected news, or the unexpected return. And the unexpected return consists of both a systematic part and an unsystematic part. So if we put those two together, we see that total return consists of really three pieces: expected return, systematic portion, and unsystematic portion. Well, what's this got to do with portfolios? Turns out that if you put together a diversified portfolio, and by diversified I mean, I don't mean, for example, 10 technology stocks. I don't mean 10 healthcare stocks. I mean a really diversified portfolio where you own different stocks in different industries. Then you can substantially reduce the variability of returns without an equivalent reduction in expected return. So we can reduce the standard deviation or risk without reducing expected return. And that's what we saw when we put together the bond fund and the stock fund earlier. The reduction in risk comes about because worse than expected returns from one asset will often be offset by better than expected returns from another. And but there is a minimum level of risk that we can't diversify away, and that's going to be associated with that systematic risk or that systematic news, those big macroeconomic events that affect every stock and affect the whole economy. So if we put this into a picture, you see that we have on the y-axis we have standard deviation, on the x-axis we have n. N stands for the number of stocks we own. And over here on the far left we would essentially own just one. And then as we start going up we're adding more and more. And you can see that as we first add a stock we get a rather dramatic reduction in standard deviation. But it's flattening out. As we add a second stock we get a reduction, but it's not as great. A third stock also gives us a reduction, but not as great. By the time we're up here, you add one more stock, let's say you go from here to here, you do get a reduction in risk, but it's not very large. And we are in fact approaching an asymptotic limit, and in fact at some point we're going to get almost no reduction in risk by adding an additional stock to our portfolio. So diversifiable risk is risk that can be eliminated by combining assets into a portfolio, and it's often considered unsystematic or unique or firm specific, or idiosyncratic is another name for it. If we hold only one asset, then we will be exposing ourselves to unsystematic risk. We can't eliminate it. Standard deviation is a measure of total risk. So standard deviation is a measure of both systematic and unsystematic risk. If you hold one portfolio, you're going to have standard deviation in your portfolio. You're going to have all the risk. So total risk, sigma, standard deviation equals systematic risk plus unsystematic risk, and the standard deviation of returns is a measure of total risk. But if you have a well-diversified portfolio, we can eliminate the unsystematic risk or a great deal of it, and all we'll have left is systematic risk. Now here's the point that you need to think about. Should the market be willing to compensate investors for risk that they don't have to hold, that can be eliminated? I'll give you an example. Suppose you have a risky job, and suppose you work around explosives or flammable materials. Should your employer give you more pay because you decide to smoke around the hazardous materials? And I think almost everyone would say, heavens no, that's silly. You're just not allowed to smoke around flammable materials. I'm not going to pay you more for taking additional risk. Well, it's the same thing with investing. The market is not going to give you more compensation for holding risk that you can, with a little effort, eliminate. And that means that what I'm saying is the market expects us to hold a diversified portfolio. And if we fail to hold a diversified portfolio, we're going to have to take the responsibility for the extra risk. We're not going to be compensated for it. Well, so here's the capital market line again. We're still looking at standard deviation and return. And an investor is going to put themselves somewhere on that capital market line. Now, where would you be? Would you hold a portfolio that was 100% risk-free asset? Would you hold a portfolio that's 100% M? Would you be somewhere in between, or would you be up here where you've borrowed money? Where would you be? Well, the answer is it really depends on how risk-averse you are. If you are an investor who is, has very low risk tolerance, you'd probably put yourself down here close to the risk-free rate. If you're an investor who wants a higher return and you're willing to take more risk, you'd probably put yourself up here. But we're not, what I'm talking about is not going to give you a theory for where you put yourself, but just that you will put yourself somewhere on that line. Okay, so So just where you move yourself along the line depends on your risk tolerance. The point is everybody is on that line. Now, researchers have shown that the best measure of risk, and here's where we kind of wave our hands and all of a sudden we're in the capital asset pricing model. The best measure of risk, and that would be non-diversifiable or systematic risk in a large, well-diversified portfolio, is what's called beta. And beta measures how responsive security is to movements in the market portfolio. It's calculated this way. The beta of an individual stock I, beta of security I, is equal to the covariance between the returns on stock I and the returns on the market divided by the variance of the market portfolio. Generally, how do we estimate beta? Well, here's an example. Here's a scatter plot where we have on the x-axis returns on the market and on the y-axis security returns. So each one of these points represents perhaps 1 day or 1 week or 1 month's returns for a matched pair for the security and for the market. If we put a line through them, and now we have another line, we had the capital market line, now we have the characteristic line. The characteristic line, whose equation is shown down there, R sub I equals alpha sub I plus beta sub I times R sub M plus E sub I, where E sub I is a random error term. This is a regression line through these data points, and the slope of the characteristic line, the steepness of the line, if you will, is the measure of beta. So if the points are in a scattergram and they're very steep, so the characteristic line is very steep, we're going to get a big beta. We're going to have a lot of systematic risk. And if the line is very flat, we're going to have a very small beta or a low characteristic risk. It's just the slope. So the formula for beta. Take the covariance between the return and the market and divide by the variance of the market. Now, what is the market? Well, not too many years ago, a guy named Stephen Ross wrote a paper in which he argued that really the market would consist of every possible asset that can be bought or sold. It would include real estate, it would include gold, silver, options, futures, options on futures, futures on options, consumable, durable, stocks, bonds, every kind of asset, government securities, everything. Anything that could be owned that was an asset would be part of the market. Furthermore, he argued, we're never going to have a proxy for that. We're never going to have something that actually captures that full market behavior. So usually what we use is some portfolio that we can measure on a daily or even hourly basis. And the one that's most commonly used is the Standard & Poor's 500. So the Standard & Poor's 500 is chosen as a proxy for the market portfolio. And what beta will be is going to depend on what proxy we choose, although I will tell you that all of these so-called proxies, whether we're talking about the NASDAQ or the New York Stock Exchange or the S&P 500, they're all very highly correlated. So there's not going to be a huge difference in beta. Also, I want to point out that beta will vary over time. So the question arises, well, how stable is beta? And generally it's pretty stable, but it can migrate quite a bit. So now we get to the capital asset pricing model, which relies on beta. First of all, the expected return of the market, and we saw this before when we went back and looked at the Ibbotson and Sinquefield data. The average or expected return on the market is equal to the risk-free rate plus the market risk premium. Now, the reason that's the capital asset pricing model is because it's going to turn out that the beta of the market is 1. And for individual securities, and there it is, that's the first time we've seen it, that is the capital asset pricing model. Sharp, Lintner, and some other guys won a Nobel Prize for that little equation. It says that the expected return on a security, or the required return if you will, is equal to the risk-free rate plus the beta of the security, remember that's the steepness of that characteristic line, times the market risk premium. That little thing in parentheses is the market risk premium. Take the expected return on the market minus the risk-free rate. Notice that there are actually three parameters in the equation. There is a risk-free rate, a beta, and a expected return on the market. All right, so this line, and this is an important point, this line will tell us what we should expect to earn on average in from a security that is held in a well-diversified portfolio. And just underline well-diversified portfolio about 1,000,000 times. Because if you try to apply this to an individual stock, it doesn't apply. Beta is not an appropriate measure of risk for one individual stock not held in a diversified portfolio. Okay, so there's the capital asset pricing model. It says again, I'll say it again, the expected return on security I is equal to the risk-free rate plus the beta of security I times the market risk premium. If the beta is 0, you would think, well, if beta is 0, we have a risk-free asset, and sure enough, if beta is 0, then the expected return is equal to the risk-free rate. If beta is 1, if you put a 1 in there, you see quickly that this required return becomes the return on the market. So what this is actually a straight line like this that goes between the risk-free rate and the market portfolio, and where beta is 1, right there, that is the required return on the market. And so now, just so you are aware, we've moved from an expected return standard deviation space where we had the characteristic market line, or the capital market line, excuse me, to this beta expected return space. And now the line is called the capital asset pricing model. So here's a little run through an example. What would we expect? What kind of return would we expect on a stock in a well-diversified portfolio if the stock had a beta of 1.5? Assume that the risk-free rate is 3% and the return on the market is 10. Well, if the return on the market is 10 and the risk-free rate is 3, then the market risk premium is 7. So if we take 3% plus 1.5 times 7, we come out with 13.5%. So with a beta of 1.5 in a well-diversified portfolio, we should expect the average return on this stock to be about 13.5%. All right, let's kind of review where we've been, and we'll be through here. How do you compute the expected return and standard deviation for an individual asset? Well, remember, the expected return is the weighted average of the returns for each of the states, and the standard deviation is the weighted sum of the squared deviations, and the variance, and the standard deviation is the square root of the variance. What's the difference between systematic and unsystematic risk? Well, the big difference is that systematic risk applies to the whole system. So it's likely to cause problems everywhere, whereas unsystematic risk is specific to a particular security or a small group of securities, possibly even an industry group. But it's limited. It doesn't apply to the entire universe. What types of risk is relevant for determining the expected return? Well, it depends. But if you're talking about just a security alone, then both types. But if you're talking about a security in a well-diversified portfolio, then beta or the systematic risk is the only type of risk that's relevant. And let's consider an asset with a beta of 1.2, a risk-free rate of 5%, and a market return of 13. And I'll leave that for you to kind of work through. But 5% plus 1.2 times looks like 13 minus 5. And I think that wraps us up. What's the expected return? Okay.